Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, we're going to talk about why housing is going to be affordable sooner than you probably think. And we're also going to talk about the crypto dump and what you can expect from that. Let's dive in.
Trade Genius.
All right, Bob. So obviously, housing affordability has been a major sticky point with a lot of people, especially the younger crowd. However, these graphs are going to give us a pretty good expectation of what to expect over the coming, let's say, 12 to 24 months?
Yeah, and before we get started, because it ties in, is that also we're telling people that the unemployment rate is going to go up, and it went up. It's over 4%, 4.1%. Fed's talking a little dovishly today, a little bit. Yeah, I've heard them talking about price pre-pandemic now, and inflation's cooling. I think they're setting the stage for cutting season. But the thesis of this whole thing is, housing is unaffordable. We're talking food is basically becoming, unavailable for a lot of people. We'll get to that in a second. And then jobs are becoming unattainable. And housing can't escape this, Phil. Absolutely not. And the other thing, too, in California, they're looking to try to push through a 50% increase in home insurance rates. So everything's just becoming more and more and more unaffordable, and people are just going to be throwing up their hands. But let's look at this chart. Never before has it been this unaffordable. And what's interesting is that the French just had their election, and normally you think the younger people vote left, the older people vote right. In this election, the older people voted left and the younger people voted right and swept in the Conservative Party. And my view on that is housing unaffordability, number one. Obviously, immigration is number two. People don't see a future, and they're throwing out the old guard and bringing in the new guard. Look at this, Phil. It's unbelievable, the numbers on this. And then if you tie it in, you say, well, they're just going to rent apartments. Oh, yeah? Let's throw this slide up. Guess what? Vacancy rates, are causing delinquency rates. They overbuilt apartments, and people and the apartments they built were all high-end, Phil. And they all got these loans because they went to the bank and said, we're building luxury apartments. Look at the rates we're getting. Even if we're 50% rented, we're going to make money. Well, hello there. We're like 25, 30% occupancy rates in a lot of these towers now and these luxury condos. Even in Irvine, California, where there's always a demand for housing, is that I'm getting ads on all my social media feeds for apartment discounts for Irvine luxury apartments, Phil. So I think we're the last area to feel it because, we're so dynamic here and a lot of immigration, a lot of wealth coming into Orange County. And I think they saturated this area as well.
Yeah, so this is why I think we have to expect at least like a 30 or 40% pullback from the highs. And I think in some markets it'll be more than that because we're already getting into that in some locales. But yeah, usually what happens is when your household income to home price ratio is as skewed to the upside as this is, that usually tops the market, and you do get that mean reversion move. And hopefully maybe we get a mean reversion move that actually gets back under that household income level and really makes things a lot more affordable, because until we see that, I don't think the housing market's going to really bottom, especially if we're going into a recession. So I think it's reasonable to expect that. Historically, that's what this real estate market does every single time. If you're a realtor, obviously you got major headwinds. Hopefully you saved up enough nuts over the last couple of years to kind of weather the storm. It's feast or famine kind of a market there, and you've had a really good run. But I think you need to be very, very careful here and watch how you're managing your money if you're in that space, because I don't see much. First of all, the upside's done. I don't really see much of any more upside. Yeah, there's still some hot markets, but price growth on what's for sale, I think, is done. If you're looking to buy, then I think, yeah, the next 12 to 24 months is going to be your sweet spot. And then at that point, I think you're going to have something that's going to resemble, will we get back to pre-pandemic levels? I don't know, maybe some areas, but you got to think there's always like an uprising, trajectory on prices. So even if you get back to in that area, maybe not as low in your particular neighborhood, like I said, 30 to 40% lower, I think then good enough. But if the economy is sucking wind really bad and we're in a really deep recession, we will see lower, So you have to kind of use your common sense there and gauge things. But I think it's definitely coming. Historically, it always does, Bob.
Hey, look, the stock market bottomed in 2009. The real estate market, I don't think really bottomed at 2014. So, these have longer legs and tails to them. And we also have the headwind of demographics too, where people, the household formation isn't there. And so I think that's going to put pressure on the markets as well. And then, which I think is more, this is a grand scheme of things, Phil. Credit Karma put out a survey that said 27% of Americans are actively skipping a meal just because they can't afford the price of food. Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening. And I don't know about you, but I'm actually seeing in the grocery store wholesale price declines in what I would call, the eye level part of the grocery store. So I don't know, people that, I had an investment in a grocery store for about 12 years. And, it's the rim of the grocery store makes the money, and what they want to really sell you is at eye level. Okay. And the eye level prices, walk around the grocery store, you see massive discounting there and those margins. So I think all this stuff rolls uphill. Those suppliers are going to get squeezed. And when they get squeezed, it's going to go back down to the initial producers too. And I think everything's going to happen. Real estate's going to back up that way. We did a report, I think last month, Phil, on construction employment. Yeah. As these delinquencies happen, you're going to see that collapse as well. And it's all going to come at the very worst time because, Phil, I don't believe anybody saved anything. And we showed that report. Savings rate went negative. That's the thing about this environment that we're in, is that the recession doesn't happen until Wall Street squeezed every ounce of liquidity out of the consumer, and then they just throw you in the trash bin. And then they go to Congress and start railing for more liquidity to be able to start the process again. But this year, I think, Phil, minimum 2 years recession, in my view, minimum 2 years. And it could be deep. And the thing about housing is housing holds, and then it trapdoors, So that's the thing. Once these interest rates start falling, you're going to see supply come on the market like it's nobody's business, because everybody's going to say, hey, our house is going to be more affordable now for a buyer, but they're going to create this supply surge that's going to keep prices lower for longer. So stay tuned, guys. We're not getting out of this thing easy. If you still have a job and you're still saving money, I would be really, really careful here, because things can light up really fast. What they say, things happen gradually, then sudden destruction. And I think this is what's happening here with the economy and the stock market. I think we're slipping past the gradual now, and we're going to start to see some volatility and violence in the economy, and then it'll translate into the markets.
Yeah, absolutely. And the other thing with housing too, Bob, is that you have the baby boomers that will be passing on their homes. Inheritances are going to be happening, and that's a massive wave. So that takes buying pressure away from the market as well. Because I think what's happening is you're going to have kids that are living with their parents. Their parents could possibly get into a bigger property that their parents owned, right? The baby boomers. So the baby boomer kids, their baby boomer grandchildren move into or stay in the houses that their parents are in, because we know that's happening quite a bit, right? Because the grandchildren generation of the baby boomers, it can't buy a home, right? So it's interesting because of that effect, that demographic effect too. You could have where it pulls a lot of housing demand away as they, pass on, and there's this inheritance wave that happens as well. So, and I don't think that's talked about enough either. So bottom line, the consumers choking out. You're seeing it every which way. Unemployment ticked up to 4.1%. We showed you guys the unemployment chart. That starts an acceleration phase usually here once that RSI goes past 50 on that. So we're seeing confirmation on that. Fed could very well, cut in July, which would be earlier, I think, than what was anticipated. Although now the markets are pricing in 2 rate cuts. I think probabilities are September and December. If they surprise in July, I think that's going to fuel that upside blow off that we're seeing. S&P 500 made a new all-time high. So Bob, what we called for a blow off top is happening. The only thing it's not happening in is crypto. And I think there's some forced selling there. But if they give us a rate cut, I think we're going to see a big catch-up move on crypto, because crypto usually follows tech, and tech's leading crypto really hard right now. And so I think we're going to see that. So I know it's been really weak going into the holiday on crypto, but look for that to possibly snap back up.
And we have data that says that we're in the bottoming window right now based on prior halvings. So just remember, the supply surge becomes a supply shock, and all the supply surge news is out, right, Phil? So Mt. Gox news is out, German government news is out, the miners sold down everything everything but like 10 or 12% of their inventory is out. So we're back to a market where it's all the big supply. And I'm sure hash rates are probably getting a little frisky here too, with the price coming down, and some of these miners now are it's unaffordable for them to print. Talk about legacy.
No, there is no printing.
To conjure up new coins.
Generate. Yeah, no.
Forgive me, Bitcoin maximalists.
And the DXY pressure is positive for Bitcoin, and that's what was really odd about this drop is that DXY. I have a indicator. I'll show it on a future podcast that shows the DXY pressure, and when that's positive for the price of Bitcoin, it's usually Bitcoin's up. The other thing we look at too is Coinbase Premium, which is a reflection of spot demand. So finally, at the bottom of that move, Coinbase Premium started going positive. DXY is already in a spot where it's bullish for Bitcoin. So you have the elements there for a pop as long as those two metrics stay positive. And again, I think getting back over the weekly 21 EMA, if it somehow can happen, which would mean a quick bounce back over 61K by the end of the week, that would be extremely bullish and might save things. Otherwise, we could mull around in this range, build a base, and then finally start scooting up. So we'll have to see how that happens, but don't panic, right? Don't panic, because if we get a rate cut, I think everything's going to kind of finally do what we thought it was going to do, and we'll see. Crypto is funny. It'll do a catch-up rally really fast. It'll make up ground really, really fast, but it does have to get over some of these key levels, and we'll talk about more on that next week. Otherwise, that's all I got, Bob.
Yeah, and it's putting a nice hammer in for today. And that's all I got too, guys. We'll be back at you tomorrow. Thanks for listening. Come check us out. A lot of people are going to make a lot of money in a short period of time here in the next 90 days. Let's be one of them. I'll see you guys later.
Trade Genius.